Welcome to the course on International Financial Management. In today's lecture, we are going to continue our discussion from the previous lecture and explore a very important and widely used financial derivative instrument which is known as the currency swap. So let us get started. Before we dive into currency swap specifically, let us first understand what exactly is swap. A swap is essentially a financial contract. It's a type of derivative in which two parties agree to exchange a series of cash flows or financial instruments over a specified period of time. So, first, there have to be two parties. Second, it has to be a series of cash flows. And third, it is for a specified period of time. Now, why would two parties want to do this? Well, swaps are primarily used for managing financial risk, optimizing cash flows, reducing borrowing cost, and gaining access to foreign currency that may otherwise be difficult to obtain. So, in simple terms, think of a swap as two companies saying, "You have something I need, I have something you need, let's trade on a structured contractual basis." Now, swaps come in several varieties. Let me walk you through the main types. First, we have the interest rate swap. In this, one party exchanges its fixed rate interest payments for the floating rate interest payments of another party, or it can be vice versa. But both party payments are in same currency. Second, and the most relevant to our lecture today, is the currency swap. Here the two parties exchange both principal and interest payments, but denominated in two different currencies. So you are not just swapping interest, you are swapping entire obligations in different currencies. Third, we have the commodity swap, where cash flows are linked to the price of a commodity, like oil or gold. These are commonly used in the energy and metal industries. And here is the key feature you must remember about all swap arrangements. Both parties benefit. Swaps are structured so that each party gains a cost advantage relative to borrowing directly in the market they need. Otherwise, they simply wouldn't enter into the swap in the first place. Now, let us focus entirely on currency swap. A currency swap is a financial agreement between two parties to exchange a specified amount of one currency for an equivalent amount of another currency. But it does not stop there. Along with this exchange of principal, there is also an exchange of repayment obligations, specifically fixed interest loan repayments denominated in two different currencies. So, what are the purpose of a currency swap? There are three main motives. Number one, hedge foreign exchange exposure. If a company has foreign currency revenue, it can match those with the foreign currency liabilities through a swap. For example, a US company earning euros can use the currency swap to create euro denominated payment obligation, thereby eliminating the need for currency conversion and removing exchange rate risk. Number two, reduce borrowing cost. Companies can exploit their comparative advantage. Each firm borrows in its home market where it enjoys the best credit terms and then swaps the obligation. The result is that both firms end up paying less than if they had borrowed directly in the foreign market. Number three, access to foreign capital. Sometimes a firm simply cannot access a foreign capital market cheaply because it doesn't have a strong enough credit rating there, or it isn't well known in the market. A currency swap gives it access to foreign currency funding through its counterparty home market borrowing. Now, let us take an example. Let there be a scenario where a US company earns revenue in euros. That is, an American company is actually exporting and it is getting the money in euros. So it needs to hedge its euro. So what does it do? Because it is getting the revenue in euro, its receivables are its assets that are in euro. So it is going to raise a euro loan or euro liability to hedge it. It is a matching principle. Similarly, we have a French company that earns in dollars. Now, this company is earning in dollars, so it is having receivable in dollars, that is the assets in dollars. So, in order to hedge these assets in dollars, it will need to raise a dollar liability to hedge its receivable. Now, each company has its own comparative advantage in the borrowing in their home market. Now, let us understand that. Now, let's say the French firm can borrow euro loan at 7.50 per annum, and American firm can borrow euro loan at 8.25% per annum. And alternatively, they can also borrow a dollar loan. That is, the French firm can borrow dollar loan at 9.50 per annum, and American firm can borrow dollar loan at 9.75 per annum. Now, let us identify their advantages. French firm has an absolute advantage in both euro and dollar loan. If the American firm were to borrow in euro, it would pay 8.25%, whereas the French firm pays only 7.50. So the French firm saves 0.75% over the American firm in euro market. In USD, the American firm pays 9.75% as interest, while the French firm pays only 9.50% as interest. This means the American firm is only at 0.25 disadvantage. Relatively speaking, it is still better in USD than it is in euro. Therefore, the total gain available from this swap, that is 0.75% advantage minus 0.25% disadvantage for the American firm, is equal to 0.50%. This 0.50% is the pie that gets distributed between the French firm, the American firm, and the swap dealer. Now, before understanding the swap structure, let us look at the participants who will facilitate the swap arrangement. A euro lender, French firm, American lender, and the swap dealer. Now, let us understand how the swap arrangement will take place, what is going to be the swap structure, and the cash flows. We know we have an American firm. This American firm is actually earning in euros. Why it is earning in euro? Because it is exporting to Eurozone and hence the receivables are in euro. Similarly, we have a French firm. This French firm is earning in dollars. Earning in dollar. Now, they are going to get a dollar receivable. Now, in order to hedge, as per the matching principle, what they should do? The French firm should raise a dollar liability. So, whatever earnings they will get from the dollar will be used to service the dollar liability. Similarly, American firm should raise a euro liability, that is a euro loan. Whatever earning that they get from euro should be used to service the euro loan. Now, in this way, they both don't have to convert the euro into USD or dollar into euro. It will come from one place and go to the other place. So, here it is like, for example, this is sales. For example, this is sales in euro, and this is then EMI in euro. Fine. So, an American firm is making sales in euro, getting euro, and these euros are going to be used to pay the EMI in euro. So, this American firm will not need to convert euro, right. Now, let us say that they both take loan. The French firm takes loan from bank in France. Euro loan at 7.50%. Okay. And this particular American firm will take a bank loan from Bank in America, and it is going to take a dollar loan of 9.75%. Now, how the swap deal will happen? First of all, this euro loan that the French firm has taken, fine, will be swapped, and American firm is going to take this euro loan. There is going to be an exchange, and American firm is going to swap for the French firm will swap its euro loan with the dollar loan, and American firm will swap the dollar loan with the euro loan of the French firm. So, hence both of the parties are going to pay each other's EMIs, and how they are going to also earn from the change, from the difference in the interest rate, let us see that. Now, this French firm will pay 9.50% to the American firm. The American firm will add 0.25%, and it is going to pay how much? 9.75% to the bank in America. It had taken a dollar loan of 9.75%, so it is paying the interest of 9.75%. Now, what will the American firm will do? The American firm will go to the swap dealer, and will pay how much percent interest? 7.80% interest. This swap dealer is going to subtract 0.5% interest from this payment and will give to the French firm the remaining. And what is the remaining? 7.75% is going to be the remaining one. Now, the French firm is receiving 7.5% interest, so it will keep 0.25% interest with it as its gain, and will give how much to the bank? 7.50% to bank in France. So, this is how they have also, we will see that they have also made savings through interest. At the same time, they have hedged their foreign currency receivables by raising liability in that currency through swap arrangement. Now, how? American firm has taken the dollar loan, but it is servicing the debt of the euro loan. Similarly, French firm has taken the euro loan, but it is servicing the debt of the American loan, that is dollar loan. Now, let us recapitulate again. French firms borrows euro at 7.50 from the euro lender. American firms borrow USD from the US lender at 9.75%. French firm pays USD 9.50% to American firm. American firm uses this towards its 9.75% USD bank loan. American firm pays 7.80% to the swap dealer. Swap dealer deducts 0.5% and passes euro 7.75% to the French firm. French firm uses the euro 7.75% received to service its 7.50% euro loan. Now let's calculate the gain for each party. We'll start with the French firm. Here, what's their P&L looks like on the interest side of the swap. French firm borrows euro at 7.50 from the euro lender, receives euro 7.75% from the swap dealer. So net euro benefit is 7.75% minus 7.50%, which is 0.25%. This is the net benefit. It pays out USD 9.50% to the American firm. Now, this is the cost of accessing USD dollars. So, the French firm's overall gain from being in the swap is 0.25%. Do you think this gain was possible if the French firm borrowed dollar loan directly? Absolutely not. If the French firm had approached a US lender directly, it would have faced a higher rate. This swap lets it borrow in euro cheaply and then exchange the obligation. And now it has to give 0.25% less, making net effective USD lending as 9.25%. Now the American firm's story. This one slightly more layered, so let's take it slowly. The American firm has two things going on. There is a USD shortfall and a euro saving. On the USD side, it borrows USD at 9.75% from the US lender. It receives USD 9.50% from the French firm. So it has a USD shortfall of 0.25%, which is actually an additional cost it still has to bear. On the euro side, it pays euro 7.80 to the swap dealer through the swap. If it had borrowed euro directly from the market, it would have paid 8.25%. Now, euro savings is how much? 8.25% minus 7.80%, which is 0.45%. Net position, euro saving of 0.45% minus USD extra cost of 0.25%, and the net gain is 0.20% for the American firm. So the American firm has effectively got access to euro at a net cost of 7.80% versus 8.25%. It would have paid going direct while only giving up 25 basis points on the USD side. Now that is a meaningful improvement. The swap dealer calculation is the simplest of the three and the most elegant from a business model perspective. It receives euro 7.80 from the American firm, passes euro 7.75% to the French firm, and the dealer margin is 7.80 minus 7.75%, which is equal to 0.05%. 5 basis point. That's it. The dealer doesn't take any currency risk, doesn't bet on the exchange rate movements. It simply sits in the middle, connects the two parties, and earns a spread on the euro flows. Now let's bring all the three sets of gain together in one view and make sure the number adds up. Look at the total now. The gains across all three parties add up to exactly 0.50%. And remember, what we calculated earlier, the total comparative advantage gain available from this swap was 0.50%, which was actually the difference between the 0.75% euro advantage and the 0.25% USD disadvantage. This is a really satisfying result. In swap theory, the total gain available from exploiting comparative advantage must equal the sum of gains distributed to all participants. If the number does not add up, something wrong is in the structure. Think of this like a conversion law in physics. The 0.50% gain doesn't appear from nowhere or doesn't disappear. It is the value created by matching two parties who each have a cost advantage in different markets, and the swap structure distributes this value in a way that benefits everyone. Now we have walked through a full swap structure. Let's step back and articulate the key features of currency swaps as a financial instruments. First is the principal exchange. This is actually one of the most underappreciated features. Unlike interest rate swaps, where only interest payments can be exchanged, currency swap also exchanges principal. At maturity, they get their own currency back at the same rate they agreed at the start. This means neither party is exposed to exchange rate risk on the principal amount. It is locked in from day one. Tenure. This is what makes currency swaps unique among foreign exchange instruments. Since these are OTC instruments, they are customized directly between counterparties, usually via a swap dealer or a bank. The term can be customized, like the size, the tenure, the interest rate, they can be tailored to exact requirements. There is no need for exchange listing and there is no standardization. But there is something to follow, and that is the ISDA Master Agreement, which is a standard rule book that both parties agrees to follow before entering into any swap deal. ISDA stands for International Swap and Derivatives Association. Instead of writing a fresh contract every time two parties do a swap, they simply follow this globally accepted rule book. It saves time, reduces confusion, and makes swap contracts legally recognized across the world. Now we have seen the mechanics, but a natural flow up question is, why is currency swap used at all? What's wrong with the other instruments we know, that is, forward, futures, or just borrowing in the foreign currency directly? Let's go through each comparison carefully. Now, swap versus forward contracts. Currency swaps covers much longer duration. It covers years. Also hedges the principal amount, not just the interest flow, which forward contract can do. Now, next is swaps versus currency futures. Currency swaps are fully customizable in size and tenor. No daily margin calls to worry about. OTC flexibility means you design the contract around your exact needs, not a standardized exchange traded contract. Now, what is swaps versus borrowing directly in the foreign markets? Swap lets you access better interest rates through comparative advantage without needing a foreign credit rating. Let me expand this. That is swap versus direct borrowing. This is where the concept of a comparative advantage really shines. Imagine an Indian company that needs to raise USD. It could approach a US bank, but it has no credit history in the US. It would either face a very high rate or be turned away. Though the currency swap with American firm that has no credit history in India, both partners borrow at home where they are known and trusted. And then comes the swap obligation. It's as if they are borrowing on each other's behalf in their own respective home markets. No credit rating required in the foreign country. This is why currency swaps are invented in the first place. In the early 1980s, MNCs were looking for ways to raise foreign capital without going through expensive foreign capital markets. and the swap was the solution. Now let's conclude so that it brings us to the end of our lecture for today. In this lecture, we first understood the concept of swaps and currency swaps. We learnt about the different types of swaps. What purpose do they serve? We also learned through examples about the comparative advantage and the swap structure and how it works with the five participants who are Euro lender, French firm, swap dealer, American firm, and US lender. Towards the end, we covered the key features of currency swaps and why they stand apart from forward, futures, and direct borrowing. I'll leave you with this. See you in the next lecture. Thank you for now.